Hello?
Hi, Jonah.
Yep. How are you?
Good. How you doing?
Good. You want to just
Great.
give it a couple more minutes for people to join?
Yeah. Tiz, are you there?
Hi there. Hi everyone. Hi Jonah.
Hey, how are you?
I'm good, and yourself?
Good. Good.
Okay. Fred, how much time should we give it? 2 minutes?
I mean, that's up to you. Yeah, I mean, I'm not in a rush, so whatever you think.
That's nice to hear. Neither are we. Okay, we'll give it until 2 minutes past. We are
Okay.
recording for those who might miss the
Oh,
beginning, so they'll be able to catch up.
cool.
Jonah, I just want to ask, do you pronunciate your name as Jonah or Jonah?
Jonah. The way you said the both ways you said it sounded similar. So I'm
I thought
not too
Jonah.
worried about it. People have been getting my name wrong for the last 30 years, so no worries.
All right, cool.
Looks like quite a turnout. Just looking
Cool.
good.
Okay, yeah, let's get started. Where do you guys want to start? I have no idea what you guys want to talk about. I'm assuming it's probably stocks, but
It's
I
a
have no idea
surprise.
what.
It's a surprise. Um,
As long as it's not politics or something boring.
Yeah. Yeah, it's not. Don't worry, it's a surprise. Fred, I think we can get started.
Cool.
I'm all good on my side.
All right, awesome. So, firstly, I want to thank you, Jonah. Hope I got your name right there again. Thank you for your time. Thank you for being here on hashtag Your Money Talks, and to all the audience that's tuning in. Thank you guys for tuning in today. Um,
Awesome. Thanks, Fred. I'm just going to give a quick intro to our guest speaker for today. He's a man who doesn't need no introduction, but I'll go ahead and introduce him anyways. I'm pretty certain most of us have our notifications on for Jonah's tweets. Pretty certain 90% of everyone is here. We love him for his transparency and how he always selflessly shares his stock gems with us. If you've read his newsletters and have seen how extensively detailed they are, it's pretty clear that he puts in a crazy hours doing his research. If you take that newsletter and you couple it with his recent genius idea of the CEO's interviews, then you have a match made in stock research heaven. He's the founder and the CEO of Lupton Capital. He runs a fund for social capital, and he doesn't know this one yet, but he's also a silent portfolio manager for Geletzo and Hosi. Ladies and gentlemen, please welcome Jonah Lupton.
Thanks.
Tess, I'm going to hand over to you.
Just in full disclosure or transparency, so I don't actually work at Social Capital anymore.
Anymore.
I don't. I left Social Capital a couple months ago because I'm in the process of launching my own ETF. So
Awesome. I'm scratching that one out there. Thanks, Jonah.
I think my ETF will be ready. We're hoping to have it live by either late October or early November.
Ooh. Okay, question number
awesome.
1. Tell us about your ETF.
Yeah,
Okay, I'm joking. We'll leave that for the end.
I think most people now. I think most people know what my investment strategy is. I'm looking for multi-baggers, compounders, whatever you want to call it, high growth, disruptive companies that have, multiple attributes of what I look for, which is, years and years of at least 40, 50, 60% growth, in some cases more than that, strong management team, a large market, the ability to launch new products and services, to expand the market, um, whether it's intellectual property or some technology that makes them, better than the competition. For instance, Desktop Metal, has the fastest 3D printing machines out there for metal and other materials, 225 qualified materials so far. So that's why I like Desktop Metal in the 3D printing space. But these are the types of companies that I invest in. These are the types of companies that I'm always looking for, screening for, researching, talking about on Twitter, talking about on Stock Twits. I mean, this is what I do full time, 50, 60, 70 hours a week. And it just makes sense for me to launch an ETF where I can continue doing this strategy, but rather than just managing money for myself, I can manage money for other individuals, retail investors that don't want to do this themselves, don't have the time to follow along, don't know how to do research, don't have the stomach to withstand pullbacks or dips or whatever it might be. So, I think I think retail investors got a little excited, too excited, and carried away last year, 2020, which was obviously a pretty easy year to make money in the markets. 2021, obviously not as easy, with the big, run up in growth earlier in the year, the big pullback. A lot of people were down 50, 60, 70% in their portfolios. You had value stocks doing well, growth stocks pulling back, and then people after 2 months, of the pullback, when they're down 50%, they start selling their growth stocks and either start chasing value or running into cash. That didn't work out so well for many of them. So I just think there's a lot of retail investors that now look at themselves in the mirror and say, okay, maybe I shouldn't be doing this myself. Or maybe if I have, $100,000, maybe I should be managing half of it myself, and then I should give half of it to other investment managers to manage on my behalf. So, I think I have a compelling strategy. I have a short track record because even though I spent 10 years in the business doing this, I then left the industry for 10 years to pursue other entrepreneurial ventures and then came back into the business 18 months ago, where I've now been doing this full time. And, what I've been doing is basically on display for everybody to see. So, I've been very, very transparent. Like you said, I mean, I have a Stock Twits room. I have my Substack newsletter. I used to publish my portfolio. I still do that in my Stock Twits room. And I'm up 95% year to date, on top of being up 200 or 250% last year. So, I think a lot of people have struggled this year. I've still had a very, very good year. And I think people realize that. And I think there's going to be some, a strong appetite for the ETF once it's available. And it's going to be cheap. I'm only going to charge 70 basis points, which is, 0.7%. There are a lot of active managers out there that charge well over 1%. So this will actually be a little bit cheaper than the ARK funds. And I still love what ARK is doing. I mean, ARK really paved the way for actively managed ETFs, but their strategy is very different than mine now. Even though we like the same sorts of companies, growth, disruptive tech, innovation, etc., they have so much money to manage right now. ARK Investments has somewhere between 60 and 70 billion dollars under management across all of their ETFs and different funds. That is a lot of capital to have to manage and put to work on a daily basis. It absolutely limits the types of stocks they can invest in. They can't invest in a lot of small cap stocks, and even mid cap stocks start to get tricky when you have that much money to manage, which is why if you look at their ETFs, you can pull up their funds on ETF.com. You can see that the weighted average market cap in their flagship ETF, ARKK, it's around 110 or 115 billion dollars. That's the average weighted market cap across my portfolio right now in my personal account, which is similar to what I would end up doing in the ETF. Obviously 4 or 5 months from now there could be some changes in names, But if you just look at my current portfolio, which is, Futu and Upstart and Celsius and Dermatech and ClearPoint and Desktop Metal and Dario Health and STEM and, names like that, the weighted average market cap across my portfolio is about 7 billion. So, you are getting high growth, disruptive companies that have a strong likelihood to 5x over the next 5 years, but you're getting, much smaller companies compared to what ARK's investing in. So my thought is, if someone has $100,000-$200,000 to give to, professional money managers, give 60% of that money to ARK, let them invest in large caps, and then give 20 or 30% or 40% to me, and let me do your small and mid caps. So that's kind of my thought process behind it. I'm excited. I have a couple investors, a couple big RIAs that are putting in $25 to $30 million each. So I think we'll get off to a pretty good start, and I'm excited to see where it goes. I mean, my personal goal is $100 million in the first 3 months, $250 million in the first year, 1 billion within 3 years. So we'll see.
Very interesting. And I just wanted to find out from you. I'm sure you saw the massive feedback you have from our side when we sent out the poster that we're having a conversation with you. And in terms of this ETF that you are launching, is it going to be localized in terms of the USA, or do you plan on hitting the international market, seeing that on this side of South Africa, you've got a massive fan base that follow your threads and are willing to, take some of your learnings and apply them to themselves. Have you thought of expanding across multiple continents in terms of your ETF?
So you mean where will it be available for people to invest in?
Correct.
I hope everywhere. I mean, that's one of the reasons that we're doing an ETF and not a mutual fund. I mean, there's a lot of reasons. ETFs have a lower cost structure, so I can charge, a smaller basis point fee. ETFs are more transparent. ETFs offer more tax efficiency. ETFs also trade intraday, since a lot of people like to look at their ETFs every day, every 5 minutes. In some cases, you can actually see a real time price for an ETF versus a mutual fund. The NAV is calculated at the end of the day using the closing prices. So it just, there are a lot of reasons why ETFs have really started to pick up in popularity. And you're even seeing some large mutual fund companies start to transition their mutual funds into ETFs. There's been a couple large companies recently. One, I believe, is called Dimension Funds. I think they just transitioned about $60 billion of mutual funds into ETFs because they realize that's what people are looking for now. I am hoping that my ETF will be available everywhere, across every platform on every continent, US, Africa, Asia, Europe. I mean, that I'm trying to make this accessible for everybody everywhere so that I can, hopefully do a great job managing money on their behalf. And then also, like, just in terms of international, I mean, I will own international companies in the ETF, but most likely only ADRs. So only companies that actually trade on the US stock exchanges through an ADR. But yeah, I mean, I want everybody on this planet to be able to buy my ETF, just like every other ETF. Versus mutual funds. Mutual funds are trickier, and that's why maybe in a couple years I launch a mutual fund, because 401k plans are still really heavy on the mutual funds, not on the ETF. So if I wanted to be able to get into the largest 401k plans on the planet, and that's trillions of dollars, between 401ks and 403bs, I would need to have a mutual fund. But when you start looking at the advisor platforms, the financial advisors, the Morgan Stanleys, the Smith Barneys, UBS, the RIA platforms like LPL and Schwab. It's for them, it's still sort of pay to play for mutual funds, which means they won't let your mutual fund onto their platform to allow their clients or financial advisors to purchase your mutual fund unless you pay them an annual fee. That's not the case with ETFs. So ETFs is just easier and cheaper for us to get across, get onto every platform. So that's why we're doing it that way.
Cool. And you noted earlier with regards to how the dynamics have changed in terms of the people that come to investing, especially when we had the pandemic last year and we saw a retail investor boom. And I just wanted to find out, from your side, how this affected you and Lupton Capital. Was Is this where the motivation for the ETF came from, or was that something that was already planned before the pandemic?
Definitely not planned during the pandemic. I mean, or before the pandemic. I mean, before the pandemic, I was running a completely different company in a completely different industry. But once the pandemic basically took that company out, I was forced to come back into the investment industry. And once I got back in here, I realized how much I missed it and how good I am at it. I mean, this is really where my skill set is, and this is where I can, not just create the most value for others, but also for myself, and continue to develop my career for the next 10, 20 years in the investment industry. So I don't see myself ever going back to, my previous career path as an entrepreneur. I mean, I suppose I'm still an entrepreneur if I'm launching my own ETF, but I'm not going to be running a large company with a bunch of employees anymore. I'm going to try to keep this ETF pretty lean. We'll bring on some analysts and portfolio managers and technical experts and other people to help me manage the portfolio and find great companies. But we're going to try to keep it at least pretty lean in the beginning. I mean, what's happened in retail is very interesting. I mean, with the pandemic and, obviously Robinhood going to zero commissions and then every other platform following, that really brought in a lot of investors. And, I think some investors realized how good they could be at investing. And I think others, like I said earlier, got a little carried away and cocky with what happened last year. But then they got a little bit of a reality check this year. So one of my big concerns is, and I really haven't broadcasted this yet because I'm just trying to think about how I want to explain it to people, but there are a lot of companies out there right now that I think are being overvalued by investors based on what they're going to do this year, for revenue growth over last year. But that growth is going to slow down dramatically next year. And that is not reflected yet in the multiples. It's one thing if a company right now is growing 50% year over year. Let's just say they have 80% gross margins, 50% year over year growth this year. They're trading at 20 times sales. Okay, fine. Well, if growth next year slows from 50% down to 30%, there's no way in hell that company still deserves a 30x multiple next year. So either that growth next year better come up or that multiple has to come down. And I just don't think there's not enough investors paying attention to what is going to happen next year, 6 months, 12 months from now, as we start to see multiple contraction in a lot of the stocks that are flying higher right now. So, that's why I'm still not chasing a lot of these tech names, CrowdStrike, Twilio, great companies. Some of them I think will grow maybe as fast next year as they did this year. I think a lot of them are going to start to see that growth slow down as they become more mature companies and you start to deal with bigger numbers, maybe more competition, whatever the case might be. And I just don't think enough people are really starting to bake in some multiple contraction next year, along with some possible higher interest rates. I don't think the Fed is going to have to wait until the end of 2022 to raise rates. I think it's possible that we see a rate increase in Q2 or even Q3 of next year, which is fine. I think, I don't know if it's baked into the market yet, but if the Fed has to raise rates in 9 months, 12 months, it means the economy is doing great. It means unemployment is at probably close to historic lows again. I don't think that's a bad thing. So but I don't think investors are really paying attention to that right now. So my focus over the next 6 months is to play a little bit more defense than offense. Like I said, I'm up 95% year to date, or like 90, I think maybe 94%. I don't need to try to reach 150%, but I sure as hell don't want to go back to 50%. So, I think the next 6 or 7 months for me is more about taking profits, not being greedy. I think we're going to see a lot of choppiness for the next 6 months in the markets, where you're still going to see that rotation from growth to value and back. Interest rates, and every time there's economic data, whether it's CPI or PPI or GDP or unemployment or any of these other numbers, or the monthly, the Federal Reserve and their comments and blah blah blah. The market's going to be very bipolar for the next 6 months. So I just think investors have to be a little bit more defensive than offensive. We're at all-time highs. Don't get greedy. Take profits when you can. Don't over leverage on margin. Don't go crazy with options. Maybe even do more selling of options than buying of options. Sell some options, sell some puts and calls to generate some income for yourself. But yeah, I mean, this is not the time where you want to start to over leverage your portfolio.
I like that you mentioned that, because I think I got my wake up call this year around the drastic dip in Feb, and I decided, you know what, I'm being too greedy. Let me play it safe. But on that note, I actually liked where you were leading to this, and for those that haven't been accustomed to your newsletters or your stock picks, what are your top five stocks, considering the pullback that you are anticipating, especially with the popular names that are on the market for retail investors?
Yeah, I mean, right now my top five stocks are Upstart, which is an AI lending company. Although they don't really do the lending themselves, they partner with banks, and then they basically license their AI models and technology to those banks, so that those banks can use a much better underwriting model to approve higher risk loans. So Upstart uses 1,600 variables to understand someone's credit worthiness versus the traditional FICO score, which is a tiny fraction of that many variables, somewhere between 8 and 12, I believe. And Upstart has all these bank partners, and now they're bringing on credit unions, and they're partnering with other fintech companies. So they're really doing a lot of incredible things on the lending side, both personal and auto. So that's my largest position right now. The stock actually got up to 190 a couple weeks ago, and then it pulled back all the way under 120 because of their 6 month lockup expiration post IPO. Uh, I've been adding to that stock for the last 2 weeks pretty aggressively. It's about 124 right now. They've already given guidance this year for 600 million in revenue, which would be about 160% growth year over year. I'm guessing that guidance was on the conservative side. My guess is they probably raise guidance at least one more time before year end. So let's say they end up doing 650 or 675. That would be 180 to 190% year over year growth. This stock deserves, I mean, with that kind of growth, 84% gross margins, 48% contribution margins, 11% net income margins, and just a massive TAM with all sorts of levers to pull. This is a stock that I believe gets to 220 or maybe even 240 by the end of this year. So by far and away my top stock pick for this year, the name that I'm the most bullish on. My second largest position is Futu, which is kind of the Chinese version of Robinhood or Webull, although they're kind of expanding now into sort of a Charles Schwab as well. Because Robinhood, obviously, and Webull are really known for their trading of stocks, ETFs, and options, versus Schwab is a little bit of that, and then also mutual funds, wealth management, and lots of other services. So, Futu's kind of doing all of that. They really made their name the first few years on the trading side. I mean, that's the massive growth that they've put up over the last year. I mean, they are growing at 200% year over year. They actually grew over 300% year over year in Q1. That growth obviously can't continue. That's just insane. So I'm expecting maybe 180 to 200% year over year this year. They're getting into crypto. They're getting into wealth management. They're getting into other sorts of banking services. They're getting into insurance products. They might even get into lending. They're expanding into Singapore. They're expanding into the US. They're already in mainland China and Hong Kong. I mean, they're doing everything right now. I actually interviewed the CFO of Futu a couple weeks ago, and he gave me a lot of confidence in what they're doing. So that's my second largest position. Dermatech is my third largest position. So they are a genomics company. And what they did is they created this patch that's kind of the size of a quarter that a dermatologist would use on a suspicious looking mole on someone's body. And they would use that patch to basically grab any, basically take skin cells off of your body, like, the top layer of skin cells. So they use 3 or 4 patches on your moles. They send those patches back to Dermatech's processing facility in California. Those patches are then processed, and then within 2 or 3 days, that dermatologist is going to get a report from Dermatech letting them know if there's anything suspicious in those skin cells, i.e. melanoma. So this is a non-invasive way, an early detection method for dermatologists to catch melanoma as soon as possible. And the sooner you catch melanoma, which is the most deadly form of skin cancer, the better you can treat it, and the higher the recovery rate, or the lower the rate of death. But this is just the beginning for Dermatech, because there's so many more uses for these patches, not just with other forms of skin cancer like squamous and basal cell, but they're also now doing stuff with psoriasis and other types of skin diseases and skin conditions. So they're partnering with lots of skincare companies like Johnson and Johnson and L'Oreal, and then they're partnering with biotech and pharmaceutical companies that want to use this genomics data to develop new drugs and therapeutics. So very exciting company. Right now their PLA product is on the market, and they're one of these companies that will benefit post-pandemic, because launching last year or a couple of years ago in the middle of the pandemic, it was basically impossible to for their sales reps to go visit dermatologists. So everything was basically done over the phone, and it's just not the same. But now that those doctors' offices are opening up again, and Dermatech has all these sales reps all over the country, now those reps can get into these dermatology offices and present their PLA solution. So I'm expecting really big things from them. And then they have another product launching later this year called Luminate, which is more of a DTC product for analyzing your skin. And then next year will be Carcinome, which is basically the PLA product, except Carcinome is going to be for those other 2 forms of skin cancer that I already mentioned. So Dermatech's my third largest position. I think this stock has only own, or maybe a better words, of all my stocks, the one that I think has the best is Dermatech. Just because
Sorry, Jonah, we are having a bit of breaks here and there. Can you hear me? Fred, can you hear me?
Can still hear.
I can hear you. Can you not hear me?
Okay, there we go. We have you back now.
Okay. Where did you stop hearing me?
You're just rounding up around Dermtech.
Okay. Did you hear it? I mean, I'm not sure what the last part I talked about was, but
Literally 10 seconds ago.
yeah, I mean, so
Yeah.
yeah, I'll just recap it real quick. So
Yeah.
Dermtech, right? You have PLA and PLA Plus is out right now for melanoma. Later this year, you'll get Luminate, which is more of a DTC product for skin analysis to determine UV damage, which is obviously a heavy indicator for potential skin cancer down the road. And then next year you'll get carcinome, which is their genomics patches for the two other forms of skin cancer, basal and squamous. And I said, if I had to pick one of my stocks that I believe has the best chance to 10x over the next 5 years, it is Dermatech. Partly because of everything I just said, and then just the size of the market. Skin cancer is the most common form of skin cancer, or the most common form of cancer. And the alternative to using a patch is the scalpel. So, right now, if you went into your dermatologist office, they looked at your mole, they saw something suspicious, they would either order a biopsy using the scalpel, or they would take a picture of it and then tell you to come back in 6 months for them to look at it again. So, that last part is not very scientific. Much better to use the patch and be able to analyze your DNA to determine if there's anything cancerous there. So that's my third largest position. My fourth largest position, and basically Dermtech and Celsius are like tied for third. So Celsius is my fourth largest position. I've been pretty bullish on this stock since last summer when I got into it about 15. Wish I had bought more because now it's a $70 stock. But I mean, to be honest, I think 70 is a very fair price to still pay. My last ad was a couple days ago, around 66 or 67. So Celsius is an energy drink. It's a healthier energy drink than like a Monster or Red Bull. No sugars. It has lots of vitamins and electrolytes in it. So it's almost like a vitamin water meets energy drink. So they use caffeine, but then they also have, other herbs and whatnot in there. The company was started probably, I think it's like 10 years ago at this point, but it's a name or it's a brand that people really only have come to know in the last year or so. They were their main sales channel before the pandemic was gyms and fitness centers. And then post-pandemic, they've really put a heavy emphasis on retail, and it's been going very, very well. So at the end of 2020, they had 82,000 retail locations authorized to carry their cans. As of the end of Q1 in 2021, that number is now 92,000. So you've already seen a pretty dramatic increase. But the biggest catalyst that people weren't paying attention to, and why I loaded up on the stock after the Q4 earnings. So they reported a Q4 number that disappointed some people, but the reason is because they were in the middle of their transition from DTR to DSD. So DTR is direct store deliver, direct to retailer, which means that if you're Kroger, for instance, and you're doing DTR with one of your suppliers, they're shipping the product to your distribution center, and then your distribution center is sending it on their trucks to your store, and then the employees have to stock it. There's a lot of problems with that, especially for high sales velocity products, which Celsius now is. So as they transition to DSD, and the reason that door opened is because Pepsi bought Rockstar in order to get out of their exclusive relationship, and then Pepsi brought on Bang and started distributing for Bang. So then Bang left all of their DSD partners, which were Anheuser-Busch. So then all of those DSD companies came to Celsius. So now they're distributing for Celsius. So, about 180 or 200 DSD partners right now, most of whom worked with Bang. And they got Bang from 0 to $1 billion in 3 years. So I'm pretty bullish on Celsius for that reason alone, besides everything else. The thing with Celsius, so in this game, it's all about shelf space and distribution, which they're obviously getting more of between the retail partners and the DSD partners. And all you have to look at to really understand what's going on is the Nielsen scan data. So, and this is going to get a little, there's going to be a lot of numbers coming, so hold on. So when Celsius reported Q1 numbers, the Nielsen scan data for Q1 was around 100% year over year. When they reported Q1 numbers, the U.S. operations were up 101% year over year. International was 25%. So if we look at use that as a good comparison, where that Nielsen scan data was right on the money for their U.S. operations, the Nielsen scan data for Q2 is tracking at 200% year over year. So if they do 200% year over year, and then you get another 25% year over year from international, which may or may not, it's going to be in that ballpark, somewhere between 20 and 30%, I think, then Celsius should put up a number for Q2 that's probably closer to 160, 170% year over year. I mean, no joke. I know that number sounds insane, but I think they could actually do it. The big impediment was going to be if they ran out of cans, because there's actually an aluminum can shortage right now for a lot of these companies. But I know that they have secured enough cans to get them through at least Q3. And I've talked to people at the company that said they have enough cans, even if Q3 numbers, or even if the numbers this summer jump to 300% year over year, which I actually think might even be possible, they would not have a can shortage. So, and I think that's one of the reasons why we got a stock offering from them a couple weeks ago at $62. They needed a chunk of cash to go secure the cans, as well as build up inventory for all of these new stores and all of these new DSD partners that are coming online, as well as Amazon. I mean, I know people that are trying to buy product off Amazon, and there's either delays or there's out of stock. So, I mean, even Amazon can't even keep up right now with demand from Celsius. So, I know the stock's had a big run over the last year. It's had a big run year to date, but I think the valuation is very reasonable, especially when you look at Monster, which is going to be their, the best comparison. So Monster is growing at about 16% year over year, and they're trading at about 8 times sales. And I know it's a more mature company, so the margins for Monster are a little bit better than Celsius. Gross margins are comparable. Monster is going to have slightly better net income margins. But like I said, I mean, you're getting 15 or 16% year over year growth from Celsius at about 8 times sales. With Celsius, I'm confusing. So that was with Monster. With Celsius, I mean, I think you could see a year over year number this year somewhere 120, 130%. And, I think the stock's trading at 20 times sales. So, I mean, if you look at that, like on a a Monster versus Celsius comparison, Celsius looks pretty freaking cheap for the amount of growth that you're getting. And Celsius only has like a 1.2% market share right now in a $60 billion market, or TAM, that's growing at 9% a year. So at 9% a year, the market doubles every 8 years, rule of 72. So, $60 billion market right now in 2029. This could be a $120 billion market. And, so if Celsius's market share, let's say they double their market share over the next 8 years, or maybe even triple it, I mean, you could be talking a market cap somewhere in the neighborhood of what Monster is right now, in the mid 40s, 40 billion range. So, I mean, I'm still bullish on Celsius. And that's why it's my fourth largest position. And then they just launched protein bars, but like at this point, that's just kind of an afterthought. They are really good. I actually had one today. If you go to Amazon, they don't use the name Celsius, and the reason why, I'm not even sure if they are supposed to say this, but if they ever sold the protein bar business or the energy drink business, they'd want to keep them separate. So, if they build up the protein bar business to, like, let's say $100 million business and then sell it, if it's attached to the Celsius name, it's probably less valuable to the buyer. So they just want to keep those things separate for now. I sort of get it, although I also sort of wish they would combine the two. I feel like Celsius is developing such a recognizable name. I'd want to parlay that into the protein bar business, but I'll leave that up to them. But if you go to Amazon and search for either Fast Protein Bar or maybe Fast Brands, FAST, you'll see two different flavor options. One is peanut salted caramel, which is decent. I'd give that like 3 stars. And then the white chocolate cookies and cream, which I would literally give 5 stars. No joke. Maybe the best protein bar I've ever had before. And I'm not just saying that. Everyone I know that has bought those bars so far has DM'd me and said that they're the best protein bars they've ever had. If you've ever had Quest bars, Quest bars taste like cardboard compared to these fast bars, especially the white chocolate cookies and cream. So if you're into protein bars, for traveling or like before the gym or after the gym, whatever, I would definitely recommend getting a case off of Amazon. I buy the case of 12. I think it's like $24, so $2 a bar, which is pretty reasonable. Um, Fifth largest position, which is kind of tied with my sixth largest, is Aterian. So this is the former Mohawk Holdings. Aterian's definitely had a rough year. This is a company with a couple different business models, or like three pillars, as I call them. One is, they are developing and launching their own e-commerce brands based on, what their Amy system is telling them. So Amy is this proprietary AI system or AI software that uses data from Amazon to identify opportunities in different categories. And then they use their supply chain over in Asia to develop products and launch those products on Amazon, Walmart, etc. So that's the first pillar. The second pillar is actually licensing that Amy software to other e-commerce companies. And then the third pillar is M&A. So, they've done 5 or 6 acquisitions, I think, so far in the last year and a half. They are using, once again, Amy to identify opportunities where maybe there's a category leader that has, a great lead on number of SKUs or reviews or ratings or any of that stuff. And in some instances, Aterian will go to that company and try to acquire them for cash, stock, or a combination of the two. And they've done a couple really good deals. And then recently they actually bought Squatty Potty, which I think some people know. I think they probably overpaid a little bit for Squatty Potty when you start to add up, the cost of the acquisition, earnouts, inventory, and then some other crap. I think they overpaid by probably 15%, maybe 20%. But, they bought the company for like 5 or 6 times earnings. And it's still a very recognizable name, strong margin, strong cash flow, international growth opportunities, and then also a lot of retail partnerships, which could open the door for Aterian to sell some of their other products through those retail partnerships as well. But, the whole idea with Aterian right now, they're working off some expensive debt, 8% interest rate plus warrants. But I know they're talking to some tier one banks about getting a larger credit facility at a cheaper rate. If they can lock that down, then that gives them a lot of dry powder to go out and do more of these M&A deals of other e-commerce brands, because there's like 4 million different sellers on Amazon, and I'm sure a lot of them would be more than happy to sell their business right now to a proven company like Aterian. And what Aterian does is they're really just buying the brand, the revenues, the ratings, the reviews. They don't care about the actual company. They don't care about the people. I know that sounds mean, but it's basically the private equity business in a nutshell. So Aterian is basically like a e-commerce version of a private equity fund where they're, using debt at hopefully 5 or 6% in the future, and then buying companies at 5 or 6 times earnings and stripping out 80% of the fixed costs. The people, the office space, all of that crap can get cut out. And then you're just bringing that much more free cash flow, stripping it out of the whatever that acquisition was. So it's kind of a controversial name right now. I'm still bullish long term. I got into the stock back in December at 12. It's at 16 right now. I think this is probably a $25 or $30 stock by the end of this year. And I could see this maybe a $50, $60 stock by the end of next year if they can get to maybe $1 billion in revenue next year through some of this M&A as well as organic growth. They recently did a stock offering about $40 million, but we don't know what that cash is being used for yet. My hope is that it's either for an acquisition, or even better, it's to get that $40 billion onto their balance sheet to get their ratios into a better place where one of these tier one banks will give them a larger credit facility. So I'm hoping for, the latter, but we'll find out hopefully in the near future. Worst case scenario when they report Q2 earnings. My sixth largest position, which is kind of tied with my fifth, is Desktop Metal. So I was actually at the Desktop Metal headquarters last Wednesday. up in Boston. I spent about 3 hours there. I toured their 2 facilities with the CEO and the co-founder. Well, Rick is a co-founder, but the other co-founder, this other guy, Jonah, good name. And they took me through their 2 facilities. I got to see all their machines in action, metal printers, fiber printers, wood printers, elastomeric printers. Like, this stuff's crazy. The stuff that they're doing is absolutely bonkers. And if anyone really understands how effed up the manufacturing world is, where these OEMs, these automakers or companies that build airplanes or ships or anything else, there are dozens or hundreds or even thousands of parts that go into those cars, planes, buses, trains, you name it. And those parts are coming from all of these freaking vendors all over the world. So there is a million different supply chain issues. All these parts are getting, there's delays with, containers and ports and everything else. So, a lot of these parts are being made through the old traditional forms of stamping or molding or laser cutting or any of this other crap. And a lot of those products could be made in these 3D printers in in the OEM's facility. So they're doing it all on site. They're controlling the process themselves. There's no waste because the old form of printing with lasers actually melts the material, so you can't reuse it or recycle it, versus the powder printing, which is what Desktop Metal does. There is no waste. You are recycling any powder that doesn't get printed, is basically, pushed over, recycled, and reused. Like, it's just a crazy process, but it makes so much sense. So it is a faster, cheaper, greener, more environmentally friendly way of printing. So this 3D printing industry, which Desktop Metal is now calling additive manufacturing, it's currently like a $12 billion industry, but experts like Kathy Wood and Chamath and Ron Barron and Bill Miller, all of them were involved in the pipe of Desktop Metal going public. So Desktop Metal went public last year in a SPAC. There was a $275 million pipe. All those investors were part of the pipe, including the co-founder of Tesla, JB something. So they, like, in their investor presentation, they've all said, that they think this additive manufacturing industry is going to grow to $146 billion by the end of the decade. Rick thinks Desktop Metal can capture maybe double digits of that. So if they're all right and this industry actually grows to 146 plus billion by the end of this decade, and Desktop Metal has double digit market share, now you're talking 11, 12, 14, 15 billion in annual revenues. You slap on a multiple of that, and now you're talking a 70, 80, 90 billion dollar company by the end of the decade. So, a lot has to go right. Obviously there's competitors, but I know most of the competitors. Rick knows the competitors. Rick was actually an investor in one of his competitors, so he was a VC before he started Desktop Metal, and his VC fund actually invested. They were one of the early investors in Mark Forged, which is now coming public via SPAC themselves. So Rick knows the landscape. He knows the 3D printing industry. He's been doing a lot of acquisitions recently to really build up their portfolio, with multiple printers, expanding the portfolio of qualified materials, which I said is, it's now 225 materials. I mean, that's everything from stainless steel to carbon fiber to gold to silver. I mean, like, it's just insane how many different materials are now qualified for these machines. And many of these machines are being used to print multiple materials. Like, you're using the same P50 machine to print metal as you are to print wood. So it's just crazy. I mean, it's just really cool to and I saw the wood being printed, and then you see the final product where they actually have, I mean, they can literally print any grain that you want. So the wood can literally look like maple or oak or whatever the heck you want it to. It's just really freaking cool. And they said that their demand for the wood products is like 10x what they expected it to be. So Desktop Metal is my 1, 2, 3, 4, 5, 6th largest position. I hope that helps.
That did help a lot. And you know what I like about your research, and I think you really go in depth, is that you actually visit these companies you're researching in and trying to find out what really is going on. And I just want to bring in Shubi to see if she does have a question that she wants to pose to you.
Cool, thanks, Tess. Jonah, I've already found something to replace the social capital segment with. FinTwit stock contest. What inspired that concept?
You said the stock contest?
Correct.
I mean, just so back in late December, I saw someone post on Twitter that they were going to, put together a spreadsheet and everyone would pick, I don't know if it was one stock or two stocks, I forget, and at the end of the year, whoever had the best performance would win a bottle of tequila. And, I thought that was fun, but I also thought we could do something bigger and better than that, given how large FinTwit had become. So, I didn't think anybody else was going to do it. So I just took the initiative myself and, launched this FinTwit stock contest. And I was lucky enough to find a couple sponsors to put in some cash so that we could pay the winners. And I think the idea was just to try to help everyone discover new ideas. I mean, there's good and bad with that, though. I mean, a lot of people were clearly picking stocks that they, it's kind of like swing for the fences, swing for the home run, try to pick the most aggressive, risky stock you could think of, where it's either, going down 90% or going up 500%. So there was definitely some of that, a lot of these really speculative companies. I tried to cut some of that out by putting in some requirements on market caps, stock price, etc. But it still made its way in there. But I think at the end of the day, it was some really helpful data. We were able to sort all of the stock picks so that we could see, the like I think it was like the 50 most popular picks across the board. So I believe in Q1 we had like 3,400 people submit picks, 3 picks each. So, what is that about? Is that 10,000? Yeah, like 10,000 stock picks, basically. I mean, obviously there's a lot of overlap, but, we were able to analyze it and see, what the most popular picks were. And I think, if I remember correctly, I think Skills might have been number one. But then, like, a lot of my favorite stocks were up there too, Upstart, Futu, etc. So it was fun. I mean, the part that kind of sucked for everybody is GameStop. The people that picked GameStop actually took home first, second, and third place in Q1, and it looks like they're probably going to do the same in Q2. Although I haven't looked at the spreadsheet in a few days. Let me just pull it up. Let me see where we are. Q2. So yeah, oh my god, yeah, here we go again. So first place has GameStop, AMC, and BlackBerry. Like, I don't know, that's just not fun. Second place
The
has
game is
GameStop and
broken.
AMC. Third place has Space. I don't know what this BRGGF is. I mean, like, sometimes there's some mistakes in here. But I mean, AMC, is that thing really up 524% in Q2? Wasn't? Oh, I guess, yeah, you're right. Because GameStop was the big winner Q1. AMC was the big winner in Q2. So, but I mean, a lot of people that picked those two for Q1 are the same people picking it for Q2, and they're going to be right again. So I don't know. I may not do. I mean, we're actually getting towards the end of Q2 right now. So if I'm going to do Q3, I probably have to decide pretty quickly. I might do it just to keep it going. I just don't know if I'm going to bring in the sponsors again. I'm just, because it's just having sponsors and then having them put up money. Like, it's just one more thing that I have to worry about, adding value for them, getting them attention, getting them exposure. Even though I don't think they expect a lot, it just still puts more burden on me. And, I already have a million other things on my plate to worry about, like running a contest like this where people are just going to pick the dumbest stocks possible. I don't know. I'm not seeing as much value in it right now as I did 6 months ago.
So Sorry, before we continue, I just want to thank everyone for tuning in to hashtag Your Money Talks. Um, I'm not sure if we'll be able to allow a lot of speakers to come on later off towards the end. But I do want to ask you guys, should any of you, the listeners have any questions, please could you go to my most recent tweet, and just type in the question in the comments, and then we will attend to those questions towards the end. Thanks.
Okay, cool. So Jonah, the other phenomena, besides the big retail investor boom towards stocks, we saw a very big boom in the crypto market as well, especially last year. And this year, I've been seeing some analytics about the death cross, especially when it comes to Bitcoin. And I just wanted to find out what your take is on the crypto market from last year until now.
Yeah, I mean, I'm probably not the best person to talk about crypto. I've never owned it. I've never owned any crypto. I don't know if I ever will. I definitely don't see myself owning it in the near future. I don't think crypto is really a currency. I mean, it's really an asset class. I don't think you could ever have a currency that's so volatile, where it can move 30, 40, 50% in a month, and also be manipulated by influencers like Elon Musk. I, you know, could Bitcoin, I wouldn't be surprised if Bitcoin was at 20,000 by the end of the year or 100,000 by the end of the year. I literally have no idea which way it's going. And for me, there's just no way to really analyze it and develop any sort of reasonable valuation, because there's no fundamentals, there's no revenues, there's no profits, there's none of that. So I prefer stocks. I feel more comfortable investing in growth stocks, or really any stocks where I can, they have products and revenues and people and customers and estimates for next year and all of that, and I can try to come up with valuations and price targets, and I can look at charts. Like, they're just, most of that doesn't exist with any cryptocurrency. So I mean, I get why people are enamored by it. I get why people want to have some exposure to it. I don't think there's anything wrong with having 3 to 5% of your portfolio in crypto, Bitcoin, Ethereum. Please don't buy the shit coins. I mean, it's just like, don't waste your money, your hard-earned money, on these just crappy coins that are most likely not going to have any value someday. If you're going to buy anything, buy the big name stuff. Like, I mean, the only two that I even know are Bitcoin and Ethereum, and I couldn't even spend 3 minutes telling you what exact. I mean, I know what Bitcoin is in theory. I couldn't even tell you what Ethereum is, or what it's going to be used for someday, or how it's being integrated or implemented into companies. I don't even know. But if someone wants to put 3 to 5% of their money in that stuff, I think that's totally fine and reasonable. Just like 10 years ago, someone would put 3 to 5% of their money in gold, silver, other types of metals or commodities. Like, that's just part of, being diversified. I don't know if I'd call it a hedging strategy, because I don't think, I think crypto is too correlated to equities to really consider it a hedging strategy. I think you could argue that gold is probably a better hedge, but it's interesting. I mean, I do follow it. I look at the prices every day, but I'm not a buyer of that stuff. I just, because if I buy a stock and it goes down 50%, okay, fine. Then I did something wrong. I'm mad at myself. I overpaid for it. Whatever. Like, if crypto down 50%, I mean, I don't know. Like, I would never forgive myself for that, because it was just stupid. It's just I don't know, different mindset.
Okay, cool. I just remembered now that around the crypto conversation, Elon took a step back from Bitcoin because of the carbon situation, and it just also led me to think that there is actually a race in terms of renewable energy. are there any stocks around that industry that you have had a look at? I do know that from December, some stocks that did pull in some big numbers are fuel cell and plug power. And I just wanted to find out from your side, have you had a look at any of these renewable energy stocks?
So I don't own any charging companies. I own three companies that I guess you could say are EV slash energy, smart energy, or connected to the EV space in some way. So those three are MP, which is MP Materials. They own and operate the Mountain Pass mining facility, where they mine and process rare earths, and rare earths are used in uh, rechargeable batteries, plasma TVs, all sorts of electrical devices. I mean, but it's the battery part where, that obviously means electric vehicles, drones, robotics, like a lot of different industries that rely on rare earths. About a third of the current supply of rare earths comes from China. Only, very small part comes from the US. But if we ever got to the point, and I think we're going to, where China starts to limit the export of important elements like rare earths, you could run into a supply shortage, and a lot of companies based in the U.S. in some of those industries I just mentioned rely on these rare earths, and that's where MP could become a much more valuable company, pricing power, all of that. So, you know, MP is sort of a play on the entire, all of those industries, drones and robotics and EV, all of it are potential customers for MP and rare earths. So that's a almost a 3% position for me. It's up 6% today. I added to it a couple days ago in the low 30s. I don't know if I'd add to it 34, but if it pulled back to, let's say, 31 or 32 again, I'd probably start adding to the position. The other two stocks that I own are LEV, which is Lion Electric. So Lion Electric, company based in Canada, manufacturing facility in Illinois. They're doing mostly school buses right now. I think they have like 4 different models of school buses. And then 2022, we start to see light duty trucks and either medium or heavy duty trucks. And this is this company, I mean, revenues this year, I think are only going to be like, well, no, I think last year was like 25 million. I'm trying to remember. This year, oh, I forget. This year is it like 300 million? Next year is 500 million. I can't remember. But I mean, revenues are expected like 20x over the next 2 years, from 2020 to 2022, as they start shipping out orders and fulfilling orders. And this is, there's so many of these EV companies, charging companies, battery companies that came public over the last 12 months through SPACs. Many of them make me worried because they've never generated any revenue. They don't have any pre-orders. Their business model is unproven. The projections, the revenue projections in their investor presentations are ridiculous. Versus companies like Lion Electric, Proterra, like they actually have orders from customers. So if I'm gonna play in this EV space, those are the types of companies that I want to lean on, are the ones that actually have revenues and they're actually producing, building trucks right now and shipping them out to customers. Unlike Nikola and Lordstown that can't get out of their own way and might be going to zero at some point in the future. And then the third one that I own that is sort of in this space, like I alluded to it earlier, smart energy storage, is STEM. So STEM came public recently, once again through a SPAC like everybody else, working with a lot of Fortune 500 companies like Starwood Hotels and Facebook and a whole bunch of other big corporate companies, helping them, energy storage or energy management, when to tap into the grid, when not to, etc. So big space, big space. It's kind of a combination. It's a software and a hardware company. Gross margins right now are pretty low. I think they're in like the mid 20s. But those gross margins will certainly come up over the next few years as the company scales up. So those are the three that I'm playing right now with energy and EV.
Awesome. Jonah, you're a book, and we can keep you here all night. But I think let's try and get some questions from the audience, and see if they have any questions for you. Guys, thank you for joining us for this conversation. You can send through your request, and I will make you speaker, and you can shoot your questions. Fred, I don't know from your side, did you get any questions from the tweet you sent out?
Yeah, I have one question. I'll just get to it right now. Cool. So, one of the audience asked, what is your view on immunoprecise antibodies? So it's
Yes, ticker symbol IPA. So it's definitely an interesting company, based in Canada. There's like two parts of the business. One is their CRO business, which is, so CRO stands for Contract Research Organization, where they do contract work, antibody discovery for basically their clients that are paying them to do that work. And then they have this second part of the business model, which they call Talem Therapeutics, where they are doing their own antibody discovery and then trying to license those antibodies out to the larger pharmaceutical and biotech companies. I mean, I do like the company. I like the people that work there. I've interviewed the CEO. I think it's interesting, especially like post-COVID. So the thought there was, if these what do they call them? Not variables. I forget. Is it the very? Oh God, I can't think of the word I'm trying to think of. But as the COVID virus mutates, right, you get all these different variations of it, and the thought was that companies like IPA or Immunoprecise would need to develop these antibody cocktails in order to fight these COVID mutations. But in the U.S. and now Canada and Europe, the rollout of vaccines has been going very, very well. So I'm not sure if that thesis is still in play. So generally speaking, I don't really touch anything biotech. It's just not in my area of expertise. There's just too much science to it, and so I like the company. I don't own it right now.
Okay, cool. I still don't have any requests from my side, so yeah, we are about to close off. If you guys do want to come on and speak, please do send through your requests. Fred?
cool. The next question is, what is your view on ATMO? No, sorry, ATOM.
I really don't follow it, so I don't have one.
Cool. Next question I have is, what is your view on Nikola?
On which one, Nikola?
Yeah.
I wouldn't touch it. I mean, if you want to be in the EV space, I mean, Tesla, Ford, GM, some of the newer companies like Proterra, Lion Electric, there's a bunch others. You go to Asia and pick up some, Lee or Neo. I can't come up with any reason why someone should own Nikola or Lordstown. Lordstown is, I mean, you've already seen the CEO and the CFO resign because they basically misled investors. Nikola has clearly misled investors. I don't know who's running the company, but I mean, that company has no credibility with me.
Tess, I have a question from Tyler. Jonah, someone is asking, what other stocks do you have in your radar that are not in your portfolio as yet?
Yeah, I mean, I have a lot of watch lists. I would say the companies that I don't currently own that are at the top of my watch list. I mean, so there's a few that I've recently sold. just because I thought valuation got extended, and then I would buy back on a pullback. So Shockwave Medical is one, I got into this stock at about 100, traded it a few times, sold it a couple days ago at 196. I'd love for it to pull back to like 180 so I could get back in. Otherwise, it's just whatever. I made a bunch of money on it, and if I don't get to jump back in, then so be it. But great company, still on my watch list. Company ticker symbol Skin. So this is a health beauty company. They make Hydra So I've never had a Hydra. I'm actually planning to get one pretty soon, just so I know what it's like. But it's like this new beauty routine that obviously appeals to females, but really anyone that's looking to keep their face looking clean and vibrant. So this hydrofacial is available at a lot of high-end spas. A lot of those high-end spas are in high-end hotels. So the thought here was, as travel comes back and as people start to pamper themselves again after they've been locked up in their homes for a year, they've been wearing masks for a year, they want to get their skin looking nice and fresh and clean again, as they're traveling, or just in the area of a spa, major cities. Hydrofacial would be a significant beneficiary of this new post-pandemic trend. So, but so I bought into the stock about a month ago at like 12 or 13. It rallied up to 19 very, very quickly. So I sold it a few days ago at 19.15, hoping for maybe a 20 or 25% pullback. Probably around like 16.50, I jump back in with a tight stop loss. So that's one that's still on my watch list. Another one is Latch. So Latch recently came public via SPAC. The SPAC was TSIA, but the ticker symbol now is LTCH. So this is a company that does remote access for residential and commercial properties. I'm sure most people have probably used remote access in some way using their smartphone to unlock a door. But then there's like other features to it, like intercom and other things that you can do. If you live in an apartment building, you can use that app to manage other aspects in your own property, your apartment, temperature and stuff like that. You can give access to other people to get into your apartment, etc. So I haven't gotten to the stock yet. The revenue projections look pretty good. I'm just trying to, like, if you look at their investor presentation, they have booked revenue and then net revenues, and so it gets a little confusing because companies like that are there's a very, very long sales cycle. I mean, my previous company, I sold into the construction industry, dealing with architects, designers, GCs, building owners, etc. So I know how long that process is. I mean, sometimes it can be 2 or 3 years from when you actually start to try to get into the specs or the specifications to when you actually recognize the revenue from the sale of the product. Now, anything like any business model like this where there's hardware and software, the hardware is always going to have lower margins, 20, 30, 40%. And then on the back end, it's that software component, the monthly subscriptions, that's where the gross margins are 70, 80, 90%. So a company like this is a combination of hardware and software. I believe that their customer churn rate is 0, because once these buildings or the owners or whatever the designers are using their products in these buildings, once it's in, it's not coming out. They've made the decision that as long as that building is standing above ground, it's most likely those Latch hardware products are going to be on those doors. So interesting company. I'm not sure when I get in. I'd probably start nibbling if it pulled back to 12 again, but we'll see. Like, I'm not in a big hurry right now to chase any stocks higher. I'm more than willing to sit on some cash and wait for stocks to come back to my price. What are some others? I'm currently not in Transmedics or App Harvest, but these are two stocks that I've written about in the past few months that I still like long term. App Harvest, I chased it higher earlier this year. I got burned. I took a loss. I got back in at 15, sold it at 20, now waiting for a pullback again. Sort of the same thing with Transmedics. I loved it, but going into their OCS Heart FDA advisory panel. The panel went well in terms of voting. They got the yes on all 3 votes, but the comments from the advisory panel people were not so positive. So the stock sold off like 30 or 40% in the next couple weeks. I sold the stock. I took the loss. I got back in at 20, sold it a couple days ago at 30. They do have the actual FDA decision coming up on OCS Heart. So I'm hoping the stock pulls back going into that meeting so I can either start a new position or maybe buy some call options. I'm leaning towards call options because I'd have, at least I'd know my, my max loss on that position. But we'll see. So those are kind of like the names that I don't own right now, but I would consider getting back into on a pullback. And then the last one I'll mention is Global E. So this is a stock that I think a lot of people on FinTwit are starting to hear about now. I got into this one a few weeks ago in the mid 30s. It rallied up to 50 or 52 within like 2 weeks. I sold it, took the profits, hoping for a pullback. It rallied up to 58. Now it's back down to 55. Interesting company. They enable cross-border commerce for companies, brands, etc. So they're kind of like the international version of Shopify. Shopify actually invested in the company back before the IPO, took a 6 or 7% position in the company. They also named Globally as their exclusive provider for this particular type of services. So interesting company. They were definitely a big pandemic winner, massive growth rate last year. I'm just curious to see, estimates are obviously good for next year, but I think the stock has run so much that the current multiple isn't reflected in next year's estimates. So either those estimates have to come up or the multiple has to come down. Right now, the stock looks too expensive based off of next year's estimates.
Okay, cool. We have 2 speakers here that have joined and want to ask the questions. I'll start with.
I only have 4 more minutes. I have a hard stop at 3:20.
Yes, we're aiming for that as well. So let's just have a double shot of the questions, and then we can let Jonah close off. So I'll let JC Guy ask first, and then followed by Pinky, and then we'll let Jonah answer those questions, and then we can close off the session. We've got 3 minutes. JC Guy, not there. Okay. Pinky, can you?
Thank you, Chess. Hi, Jonah, and thanks for joining us. It's a pleasure. Actually, I had 2 questions, but then I'll just touch on one. For new investors or traders starting out, what would you say it's an ideal portfolio allocation between growth stocks versus value stocks?
Yeah, I mean, so that's tough. I mean, a lot of investors are one or the other. I think some of the best investors do both. I'm certainly more of a growth guy than a value guy, but even though a lot of value stocks have had a really great run over the last 3-4 months, some of them still look really, really cheap. And then some look very overvalued. I mean, there's a lot of value stocks that I would not go chasing right here because I just think there's too much good news baked in. And then, when you get stocks moving that fast, then they have to back it up with earnings. And I'm not sure some of them are going to be able to do that. But I don't think you want to be 100% growth either, especially just because things can change so fast, with interest rates or just the sentiment from investors, people taking profits, whatever the case might be. So, for me, I mean, if I go through my stock, I mean, like Futu, though. I mean, Futu, like I said, Futu is going to grow this year at 180 to 200%, 84% gross margins, 50% net income margins. I think they do 1.2 billion in revenue this year, which means 600 million in net income. The market cap on Futu, I just want to double check, it's up to 24 billion right now. So 24 billion divided by 600, so 40. So Futu which, like I said, I think is gonna grow at 180 to 200% this year, is trading at 40 times earnings. That is so freaking cheap. I mean, if this was a U.S. company with those numbers, growth, margins, etc., this would be a $250 stock. You know, a $50 billion market cap probably. So, like, I would argue, I mean, people want to call Futu a growth stock because it has a high growth rate. It's priced like a value stock. So, like, I don't even think of Futu as a growth stock. I just think it is or if I do, it's a very, very undervalued growth stock. Even Upstart. I mean, Upstart this year, worst case scenario based on their own revenue projections, is 160% year over year. Like I said at the very beginning, I think they do 180 to 190% year over year if they raise that guidance to 650 to 675, and God forbid we get 700. Now we're talking, over 200% year over year growth at a multiple that's very, very reasonable, if not cheap once again. So, like, there are growth stocks out there that are growing at 45%, trading at 30 times sales. That is ridiculous, especially since we know most of them are going to start to see revenue deceleration, which means that revenues are still going to be higher next year, but you're not going to, if they grew 45% year over year over the last 12 months, they're not doing that again. And I mean, I'm just generally speaking. So if that growth is going to slow down from 45% year over year to 30% year over year, the multiple is going to have to come down. So if that stock is trading at 30 times sales right now with 45% year over year growth, and that growth next year trades, it slows down to 30%, that multiple is going to get cut in half, if not more. So I think people need to be mindful of what they're paying for these multiples on certain growth stocks that benefited from the pandemic, that are going to start to see that revenue deceleration, which leads to multiple contraction, which leads to significant haircuts on stock prices. So that's where I said, like, I'm playing more defense than offense. I'm not chasing high, price to sales stocks. I'm going after companies like Upstart, Futu, Celsius, etc., that are growing at 100, 150, 200% year over year, but they're actually making money. They're cash flow positive. Margins are great, blah, blah, blah. So, I mean, there's a few examples in there, like Dermatech obviously is a high, uh, you know, price to sales stock, but this is also a company that I believe is going to grow revenues at 200% a year for the next 3 years as they launch these new products in this kind of, like, skin genomics industry. So, like, there are examples where I will buy one of those high multiple stocks, but it's only because I expect the fundamentals to catch up to the stock price.
Awesome. Thank you so much, Jonah. I do see that we have crossed time, and I think I should let you go now. We really
Okay.
appreciate you making time for us, and yeah, very
Anytime, man.
thankful.
Happy to come back anytime.
Yeah, expect that invite very soon. And yeah, so for everyone who joined us, thank you so much. We will be having our next talk on Saturday. I will send out the details. But yeah, thank you so much to Jonah. As he
Thanks,
said,
guys.
he will join us again. And yeah, enjoy the rest of the evening. Peace, everyone.